I still want to say that there's like, I think there's almost like two dimensions to this, right? I think we see, and I think also like the institutional side of things, and especially also banks, I think we've seen a lot of them starting initiatives to really almost invest, right? Like go in at equity, as you say. And I think it makes sense. There's a huge, I think, opportunity to build larger project, as you call conglomerates, or really build project developers that can deliver at scale, where you have all the efficiencies, where you have like solid MRV that you can harmonize, standardize across your project base, right? Which obviously would help. But then the other side that I think I'm probably more looking at every day, right, is kind of we still need people to buy this ultimately, right? Like this, all of this doesn't work if there's no buyer base. Yeah. Exactly.
Welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside Rene Velasquez. And today we have on an amazing guest, Magnus Drewelies. Thanks for joining today. We've got some great stories and topics to dive into from this week. But, before we get into that, I would love to introduce Magnus to the audience and also to learn more about your background in the space and your work in the industry. So we'd love to start there and hear from you there.
Thanks, Eddie, for having me. And obviously,
Magnus,
always
how did you go
see
in
pronouncing
pronouncing your last name? It wasn't.
It was amazing. It was amazing. It was almost perfect. It was almost perfect. We'll give him that. No, but super happy to be here. Maybe just to give some background. Magnus Drewelies, as we now know, I'm the CEO of Ceezer. My original background was in chemistry and business, came into the carbon markets really almost like at university. That was over 10 years ago now. Spent a bunch of time in different industries, but then returned in roughly 2021, roughly like 4 years ago. And built Ceezer. We're an enterprise platform to screen, purchase, and manage carbon credits. So we support large enterprises in building risk-adjusted and impact optimized portfolios, invest in those, monitor those, and then report on those. So we see a lot of different buyers doing a lot of different things and work with a bunch of amazing, obviously also projects on the supply side. Yeah.
Awesome. Well, thank you for the introduction and for the clarity. In this first segment, I would love to unpack the newly released State and Trends of Carbon Pricing 2025 report from the World Bank. It's kind of a sweeping annual snapshot of carbon pricing instruments and trends around the world. And I think it gives us a unique window into how global carbon markets are responding to policy and economic signals and new integrity frameworks. So breaking it down from some key facts and figures and look at the more broader global landscape. As of 2025, there are 80 carbon pricing instruments in place, 37 emissions trading systems, and 43 carbon taxes. And these now cover 28% of global greenhouse gas emissions, up from fewer than 10 schemes in 2005. So there's been significant progress globally made on compliance carbon pricing systems in the last 20 years. And there are new ETSs underway, but shifting gears toward the carbon credit market, we saw that the retirements rose 15% in 2024 compared to 2023. We saw that compliance-driven retirements tripled year over year, now 25% of total retirements, up from just 9% in 2023. Over half of these compliance retirements came from California and the Quebec ETS due to the end of their 3-year compliance cycle. And now international credits are permitted in systems like Singapore's tax and Korea's ETS, expanding demand potential. And specifically on some voluntary market trends, we saw nature-based removals surging, with retirements up 25%, with increased buyer interest and tightening supply of high-demand nature-based credits. We saw clean cooking credits, 50% higher retirements year on year. And we've also seen major capital pledges, groups such as the Symbiosis Coalition and Frontier, making long-term offtake commitments for nature-based and tech-based removals. And specifically with regard to the early growth of engineered removals, we saw 8 million tons purchased, but only 318,000 delivered. So that's a 4% fulfillment or delivery rate. So a lot of future signaling, a lot of future demand in this area. So taking a step back, we'd love to hear your thoughts on some of those facts and figures, and also what do you make of this? What do you think of these surge in compliance credit retirements? Are we seeing a kind of a structural shift in demand, or was it a blip, driven by some deadlines? What are your thoughts on nature-based removals? There are a lot of different angles to unpack here, but would love to hear your guys' thoughts and takeaways.
I mean, as you said, I think lots of different topics almost like to unpack, right? I think maybe what we observe on Ceezer, and maybe to start there on the voluntary side of things, right? Mm-hmm. I think it definitely goes in line that there's a persistent trend that buyers want to buy more removals. So I think it's no surprise to me that their nature-based removals, being kind of the most accessible ones in terms of pricing, are growing, and that is something that I think we see both in value and in volume, right? I think maybe just like one number, I think year on year we've seen probably like removal volume double on Ceezer. So I think on average we see 100% more volume being traded in the removal space, and that includes nature-based and technical solutions. I think I'm a bit more surprised by
that. Is that traded on spot or across forwards as well on your platform?
That is across spot and forwards, and that's maybe the second point, because I think the market numbers that we're looking at, we estimate actually the forward removals to starting to amount to almost like 50 to 60% of the spot retirement value, right? Like if you look at the value, the forward agreement is actually quite significant already, because you have a way higher per ton price. So if you look at a roughly like $1.3 billion market, and we have estimated on our end maybe like a $600 to $700 million in forward removal deals that have been closed, not delivered, as you said, Eddie. So there's almost like a parallel market that's starting to be quite significant on the removal end of things. And I think you can see this in the macro, and we can see this in the large offtake agreements and the coalitions. But we also see this on a more micro level with the buyer base that we work with, that we definitely have a huge increase in also LTOs, like long-term offtakes, maybe, not the 10 years, maybe more the 3 to 5 years, that are really starting to take shape. And that I think is a pretty exciting news, right? And I think it really definitely helps the market. But also interested, Rene, I don't know, what do you see on that?
Yeah, I think it's right. I think that this preference shift towards nature-based removals is reflective of this overall kind of trend in the market, right? There's been this erosion of trust on the nature-based avoidance, which I think is oversold, quite frankly. I think there's an opportunity there because there's a lot of distressed assets there, and there's actually still quality. But the buy side preference has been shifted in large part towards nature-based removals. And there's a realization that there's just insufficient supply. So the spot volumes are just there's insufficient volume around. When you look at it, there's two main classes. It's nature-based removals across ARR and then blue carbon, effectively, so mangroves. And both of those project types take a long time to implement, and then ultimately to start to yield supply. So whatever anemic supply is in there and available and deliverable at spot gets snapped up pretty much immediately. There's very little secondary market trading of that, so it's kind of hard to discern the mark to market kind of component there. And then to your point, when there are project developers that are bringing these projects now to the market, in order to get financing, they need securitizing that transaction or the underwriting or the investment into that project by securing offtakes. And so it's this kind of synergy that exists. And it begets these kind of buyers coalitions. Buyers are realizing that they cannot go into the market and secure plentiful supply. It just doesn't exist. Right. And so what they end up finding is that they have to go on the forward curve in order to mitigate the failure of supply in the long term. The thing that's not effective or efficient right now is the price discovery piece. And so we're working on this right now with some clients that are bringing really large scale projects to the market on the ARR side. And it's how steep or how shallow is that curve? And then when you look at it out on the 25-year curve, let's just go out to 2050, it's MSCI has got some great data. We talked to Opus that had some great data. Talked to a number of different folks that have got data, but it's it's very subjective. There's some pretty big error bars in there. And so now it comes down to, buyers always say, oh, what's the price curve? And the answer is, I'm sorry, but there is no price curve. It's going to be price discovery. Like, that's just, sorry, newsflash, guys. It's not a linear, like, analysis of it just goes up like at a compound annual growth rate of 10, 13%. No. It's not like that. Maybe in the short part of the curve, like at the front part, it can step up on an annualized compound annual growth rate. But then we think that curve essentially that floats. There'll be a discovery of a benchmark or establishment of a benchmark, and that then deals get priced on the longer tenor, meaning beyond 5, 10 years out relative to a benchmark. And that's where I think that there's a lot of potential for interest from the big commodity trading houses, financiers like banks, et cetera. Maybe not banks per se, but like hedge funds and others who might want to take positions at a discount to the benchmark. And then now there's a perfect carry trade. So if there's an emerging sort of derivatives market with a futures contract, they can know that they're going to be at a discount to that, so they can sell short in the futures and they can take that carry subject to delivery. So that is the kind of, I kind of liken it to the old bikes. They used to have like the kick bike bit where you kind of kick the motor starting. That's what that is. In my view, like it's going to create like this forward momentum, and then that futures market really creates a really much more robust forward price model, and now financing actually can really take hold.
I would agree, and I think just to add the perspective that I think we see almost like from also like buyers just like trying to figure out, right, like, do I need to secure? And I mean, as you say, I think the times are over where I can just like go to market for the next month and be like, I want to have a great nature-based removal project, spot and retire. Like, it's not going to work, right? Like, that supply is going to be traded in the future.
The other thing, completely, but everyone's looking for the same thing. They're all looking for unicorns.
Exactly.
Right? And
exactly. No, but it ends up being a very small pool that most people are looking at. So even like, I think individual buyers that are not even like, in the market as institutional, they're starting to be like, okay, we probably want to do this for the next year. And indeed, I think the price curve, super, super difficult. I think what to predict, and I think that's often like the discussion also that corporate buyers have, right? It's like, how do I legitimize investing in 3 years, 5 years if I can't really make the case? Is that like giving me a price advantage? And I think, I don't know how you look at it, we also see more and more forward curve. If you just look at forward supply that is priced higher, right? So I think we used to come out of a time where if I buy a 2028 vintage, I would get a discount. In many nature-based projects right now, we start to see the opposite, right? Like, actually it's more expensive. So there's price increases already priced in, which obviously is also like hard to sometimes navigate if you're not in the market. But it makes sense because it's a very small pool. It's hard to grow. That said, I think we do see, I think buyers kind of double almost like what they pay now. So I think and that is not only nature-based, that goes for all the removal pricing. And there's definitely a driver of this can also be, stepping a bit more to biochar, more permanent, more expensive solutions. But we also see that like they're willing to curve. Exactly. You have to go up also for volume at some point, right? Like if you wanna make sure that you like have a good thing and you have a good, a good mix of different types, a good mix of different profiles.
I might disagree with you there,
but
I agree with you that that's the current status of the market. But coming back to something you said earlier around the lack of institutional participation, it's due to ticket size. So, Eddie, I know we're diverging from your initial question around the World Bank state of trades and I want to come back to it. But like, this is really interesting commentary because essentially, like Magnus, you're seeing this on a day-to-day basis. But it's institutionals, they need to write big tickets. And it's to do with the small scale component, right? So our market suffers from two things. It suffers from a lack of speed and a lack of scale. And if we can increase the speed and efficiency with which projects are accredited and verified, right? And we talked about that briefly in previous episodes around kind of digitization of PDDs and this kind of transformation of the broader ecosystem, which is underway, which is great. But if we can achieve scale, now institutional money can actually start to come in. Why? Because doing the due diligence on projects, especially if they're piecemeal, it's too much work and the credit and counterparty risk is just too significant. And that's why I think we're starting to see, I predict the next wave is going to be an M&A wave of inefficient small projects essentially being rolled up into much larger project sort of groups, right? Conglomerates, for lack of a better word, that can create a level of efficiency and operational kind of excellence at the top co level, and then have the various SPVs. That's one way to achieve scale, by having a broader, more diverse group of offerings in a portfolio at the top co and project level. And the other one is just bigger projects. And we're seeing both of those emerging. We're working interestingly with clients doing both of those approaches. I think that once we start to kind of hit that tipping point and we start to see these big scale projects, like we're talking billion trees or bigger, right? We're talking hundreds of thousands, millions of hectares, which is phase implementation. It's not going to happen in one, like in immediate hit. That's when we start to see institutional interest, because now the ticket size at a Series B, Series C, you're talking hundreds of millions of raises, and so now they can get that equity exposure there, right? Or they can start to look at much more kind of supply that's on that certainty, right? And you do 100%. The DD one time, the counterparty like credibility, the management team's experience. You have a really robust data room. You have forward cash flows. You have all of this robust data set. You do that DD, and then you can justify at the financial investment decision level. Oh, this is actually a really worthwhile investment, and I'm going to write a ticket.
Yeah.
As opposed to, great, I write a ticket. How much is the ask? And it's like $1 million. Sorry, but Mizuho won't get out of bed.
Obviously, yeah. I mean, that's obviously too small for the institutions. I still want to say that I think there's almost like two dimensions to this, right? I think we see, and I think also like the institutional side of things, and especially also banks, I think we've seen a lot of them starting initiatives to really almost invest, right? Like go in at equity, as you say. And I think it makes sense. There's a huge, I think, opportunity to build larger project, as you call conglomerates, or really build project developers that can deliver at scale, where you have all the efficiencies, where you have like solid MRV that you can harmonize, standardize across your project base, right? Which obviously would help. But then the other side that I think I'm probably more looking at every day, right, is kind of, we still need people to buy this ultimately, right? Like all of this doesn't work if there's no buyer base. Yeah. Exactly. And that's and that's where like we need to make it really easy to understand what is quality. We need to make it really easy to buy. We need to be really able to understand what pricing is. And so obviously both of this needs to work. I feel like historically, at least that's my opinion, it hasn't lacked on the supply side so far. It really is still, I think, lacking on the buyer side, where we just like need to make it super easy for all companies to enter and any company to really kind of have a stake in this that is remotely applicable, not only by compliance schemes, but increasingly maybe also by compliance schemes. Coming a bit back to your point, Eddie, on the increase of compliance-driven credit retirements. Yeah.
Yeah, no, I completely agree. And do you think that's, on the buy side, it's a result of a lack of trust in the market or in certain methodologies? And then we're seeing, because there is a great fragmentation in the marketplace, like you said, there's pockets of demand here, untightened supply here. Maybe because there's a greater trust in the specific methodology here, like Vera's VM 47 or the ICD-CM CCP framework, right, where there's greater trust or integrity behind the buyer's decision, whereas they look at other things with a little bit of hesitance, and that's why we're seeing buyers. The demand is just inconsistent, right? And ultimately, that drives the. I mean, that's where the risk comes from, right? Because no large institution is gonna write such a large check and say, oh, okay, what's we're relying on the sales of these credits in 10 years. We don't even know what this voluntary market's going to look like in 10 years. Or, there could be an article that comes out on a similar project and just wipes out all of the revenue. So I think that's.
I think all that you just said, right, has happened, I think. So I think, to me, what I'm looking at, I think it's a combination of, to me, like basically three factors. The first is I think the use isn't always clear. Like obviously there's voluntary frameworks. We obviously know that, like, if you look at SBTI, if you look at all the voluntary side of things, there's frameworks, there's rules. It's not 100% clear how carbon credits factor in. If it is clear, it's often very much in the future. So I think for buyers right now, it's always hard to find a long-term commitment. Although I have to say that even if you have a net zero target on SBTI in 2030, we see buyers starting to purchase because they're like, listen, we want to learn this. We don't want to like approach our net zero year and be completely exposed to a market that we haven't never dealt with, right? Which I think is a smart thing to do. But that obviously isn't enough to like reach scale quickly. So the second point, as you say, is there's a lot of uncertainty around credit quality and applicability. And I think that goes both on voluntary and on regulatory or compliance markets. So what does removal and permanent removal mean for SBTI or for ISO net zero or whatever, right? Lots of discussions still ongoing. I think kind of hard to gauge for many buyers to understand, if I want to commit to a project long-term, like I better be sure this is actually being used against the target that I want to have in 10 years. That currently is still kind of a challenge, right? And then if you look at the compliance scheme very similarly, I mean, there are obviously compliance schemes that have a component where you can use, carbon credits from the VCM to kind of fulfill your target. But if you look at the larger schemes right now, like EU ETS, where there is an abstract decision that has been taken on, removal needs to be part of this. And there is obviously, the CRCF, so the Carbon Removal Certification Framework, as like a first indication of what removal might be applicable, but many, many questions where it, again, is really, really hard to hedge the market. And then I think third level is almost, as you said, is kind of really base quality. Is like, am I investing in a specific project that really makes sense? And I think there, and that's maybe where I'm a bit more conservative around the conglomerate idea, Rene, is it's very project specific, right? Like even if you have the same methodology, similar project type, similar MRV, the specific project risk might still be really, really high for one project versus the other.
But this is
and I think that's really hard to understand, right? Yeah, exactly. Completely. So there you need someone to come in to validate that either before or centrally, or you need your own tooling as a buyer to understand that.
From the buyer's perspective, absolutely. But offtakes can actually be done at the, on a project specific SPV basis. What I'm saying is kind of this efficiency. I'll just call it out, right? Like Imperative comes to mind. So Scobie Mackay and his team, I think they do an excellent job, and the proof is in the pudding. Like they've been able to raise, the last project level raise that they did was getting $250 million in commitments from Freepoint Commodities, Rubicon, and Artemis, DRW, and those are done at the project level. Right. So the projects are really well financed. It's based on a milestone payment. So it's like not the cash doesn't come up all up front, but those projects are secured in terms of financing. And then you've got a really, really solid team that really knows what they're doing, going out there and doing implementation, doing all the technical stuff around mangroves and ARR and different project types. But now what you have is a portfolio that's really interesting. And that's why you get investments from Gen Zero and other folks at the project level as well. It starts to really make it attractive. And I think that's kind of, the direction of travel for sophistication of our market, where historically, what I kind of find is this chasm between project developers coming from this NGO world and not having necessarily the financial acumen and rigor to speak the financial language to the potential investors, and then coming and saying, give me money so invest in my project. It doesn't tend to translate that well. In a short supply market, sure, people jump that and then they want to take it, right? We saw that when we launched the NGO contract and nature-based avoidance was just roaring, right? Someone would jump and effectively finance these projects or provide the necessary offtake to underwrite it. And everything was great when the price was heading towards $15, $16. But then when that market fell and pulled back and liquidity dropped, those projects became unbankable. And I think that, that's the kind of realization. Like oftentimes a lot of those projects just weren't very sophisticated. And I think that this kind of transitional direction of travel towards more sophistication, I think, is inevitable. And I think that we'll start to see over the next 2 years or so a realization of there's a short squeeze ahead. We don't know when that's going to occur, when the demand kind of comes in, but because supply remains constrained because of the kind of bottlenecks that we have, there's a really great opportunity to start to invest right now, identify and take your pick of the really good assets, project level assets, roll them up, and then start to create a level of sophistication so that when you seek investment, you take it at Topco and at SPV project level, and you can actually now start talking in 6, 8, 9 figure kind of checks. It's a lot more interesting.
No, and I agree. And I think, as I said earlier, right, I think that in the small scale, we see the right direction of travel, right? We see like increased spend per ton. There's a higher willingness to pay. There's obviously like more interest and like details on how is this, how is MRV running? How closely is this managed? So I think that will help. But also to your point, Eddie, on the compliance inclusion, I think that's also something that will play a role, right? I think what we're kind of seeing in it's fungible, but also there's just really hard demand ideally coming along the way, where if policymakers do their job right, which I mean that remains to be seen, will actually also increase investment in the right projects and in the projects that can deliver on time and at quality. And I think that is something that will further help to make it bankable and to get the right capital flow into those projects.
Yeah, certainly.
So Eddie, should we come back to the World Bank?
No. I mean, I think it's a good point to. I mean, the World Bank that report touches on everything. So I think this is a good time to shift maybe to the story on Vietnam's ETS, because it's the kind of that what you just mentioned, Magnus, that convergence of compliance and offsets, right? So Vietnam has taken a major step in operationalizing its national emissions trading scheme, set to launch on August 1st, 2025. The ETS will initially cover large emitters in the power, cement, and steel sectors before expanding to other industries. And this is a significant development for Southeast Asia, right? Not only because of Vietnam's economic growth and emissions trajectory, but also due to the 30% offset threshold allowed in the scheme. So its hybrid approach to decentralizing the sectoral allocation authority and the explicit recognition of Article 6.2 and 6.4 credits, marks a significant milestone. So they will also be establishing a national trading platform and registry open to financial intermediaries, and the credits must be transacted on that platform, adding structure, some transparency, and this could be a significant step for broader ETS adoption and credit integration in Southeast Asia. As we see, Singapore has offsets, both international and domestic, allowed in their carbon tax at about 5%. So yeah, would love to hear your thoughts on this. And the 30% offset threshold is unusually high. So what do you think the trade-offs are between this compliance flexibility and like real decarbonization? And also would love to hear your take overall on this model that is coming out of Vietnam.
I think I'm not an expert on the Vietnam scheme. I think, first of all, I think it's great to see that more and more countries are starting to have real ETS in place. I think that's great, right? And I think that's really something that's needed. I personally do fundamentally believe that decarbonization will only be possible in the long run if there is some flexibility, some economic incentive, but also to give companies time, space, and options to actually achieve their targets, right? And this is where market-based mechanisms or cap and trade systems have been really successful in doing so. I do also think from a more like macro perspective, it makes sense for certain regions or countries to maybe have a higher share of carbon credits or of, kind of negative emissions, coming from abroad. If you have heavy industry, it's going to be really, really hard in the short term to decarbonize your assets, like really. And I think if you look at countries that haven't had now 50 years of great economic growth or economic leadership globally, I think it's also fair to assume, there's the burden that the industry can carry is just maybe a bit lighter. So I think offering more options to be effective and to have a similar or same climate outcome via market-based mechanisms internationally, I think that's a good option. What I'm observing more broadly, and I think I also obviously work a lot in policy in Europe and then also in Germany, where I'm based. It seems a bit like there is a little, I want to say, like renaissance of integrating international credits into compliance schemes, right? Like in Europe, they have been completely faded out. Germany had completely faded out the ability to meet your quota with international credits. And now we're seeing this suddenly coming back up. So in Germany, we have a new government that just formed a few months ago. In the coalition treaty, suddenly, to a lot of surprise, there was removal in there as one option to achieve your national quota. There was 3%, not 30, so a tenth of what Vietnam is offering, to also plan to achieve your quota as a company with international credits, right? So I think carbon markets are back on the table for many policymakers because they also offer a lot of, I think, good arguments, flexibility, but also I think if you look at maybe Germany or Europe, also like a way to support international climate finance, which I think is still something that we really have a role to play, I think, in Europe to do that globally. And I think similarly with the EU ETS, right? Like phased out all of the carbon credits that you could use to achieve your quota. But we're seeing this now being phased in again. There's, the targets in place. Obviously, the implementation is still outstanding and lots of questions. But I do think we see that carbon markets, and more specifically, really also the voluntary market, is starting to being almost like a bit like reintegrated into many of the larger compliance schemes. And I think that I personally think that's quite a positive development.
Yeah, what he said. No, I think it's really great. Yeah, I'm not going to purport to be an expert on the Vietnam ETS, but like I read it like you did on Quantum. I think it's great. I think it's really interesting. it's such a high quotient of offsets that are allowed into the system. I think that's actually a kind of an example of where the direction of travel across many other compliance systems in the future. It just allows for flexibility. So you have this cap, and then you have the allocations, and then you can have fungibility of these instruments. It actually can then help to spur the development of this industry, like we said, around carbon finance, and think of it as a release valve in terms of compliance. And so where compliance could be price sensitive, in theory, the offset mechanism allows for that deflationary kind of component. So you set a cap, and then these offsets can come in at a discount too. It also creates plenty of opportunities for the local economy to start to create jobs and projects in and around carbon. I'd love to get more thoughts and kind of details about that before kind of providing more of my opinion on it. But Eddie, do you know in terms of the types of offsets that will be eligible into this system? Is it going to be Article 6, 2 ERs like ITMOs? What's or 6.4 ERs?
6.2, 6.4, yeah.
So
but I'm not sure on
and then 6.4
specific domestic credits. But I think like with what you said regarding the integration, I think like net zero targets are kind of difficult for, I guess some people would say that net zero targets are not for hard to abate companies, in a sense like that they need compliance and they need a forcing policy or a regulator, because net zero is primarily for the higher profit per ton companies further up the value chain, whereas cement and aviation and steel, et cetera, have very slim profit margins and very high competition. So there's no way that they can take on the costs needed for their net zero transition if their competitors aren't forced to do so or have a regulatory scheme in place to do so, right? So I think these are the only way that these emissions can be dealt with through policy, and to some extent by higher profit per ton actors further up the value chain reaching their net zero targets, like Microsoft paying extra for green steel or zero carbon cement and SAF. Like hard to abate companies should show what they can do to lower their emissions by themselves, and then what is conditional on policy and changed customer demand. I think like corporate standards should not try to set rules that try to work for everyone, because that just sets up whole sectors for failure and suppresses ambition, right? So I think this is really needed, the compliance system in place that allows, because the Vietnam, it's for large emitters in power, cement, and steel, and like I said, that's they're operating on very low profit margins, and if their competitors aren't forced to do so, then it's just going to set up the whole sector for failure. So that's my thought on what your take was. But sorry, I kind of took it to another direction there.
No, but these are good directions, right? Like look, our markets are inherently complex, right? But it's good. This is a good direction of travel. I found it curious to see that, you mentioned Singapore has a 5% inclusion component. And I think Korea is like 10%. California might limit it to less than that. I think it's 4%, something like that. So it's great for a project credit, like project-based approach, and folks that were proponents in this space. It's fantastic. It's gonna evolve, but good, strong policy direction leads to really good outcomes. So kudos to the Vietnamese folks, and let's just see how this develops. Magnus, I see you think.
Maybe, yeah, I agree. But like one more point that I think is also important to kind of think through in like across compliance schemes, right? But like if you have schemes that want to go to net zero, which there are a few, like most, like biggest one probably Europe, you're gonna need removal. Like that's already part of the commitment, right? It's absolutely clear that we're not going to get to a full zero with the industry. And I actually fully agree with you there on the industry specific needs. There is a bunch of industries that really will have a hard time even getting close to the last 10-50% that probably won't get there, right? There's also like an alternative. So that's just part of the reality. So I feel like having these smaller, even if it's under 10% or 10, 5, going to 30% of, let's say, project-based instruments that can feed into compliance schemes, I think that helps because you're also starting to build up the supply that you will need in the long term anyways to hold your commitment, right? I mean, it kind of funnels the money early on into the removal that you might need in 10, 15, 20 years. And the reality is it's not going to be there, if we wait until the year before to be like, okay, now we're going to start doing this. So I do think that if policymakers do smart choices about a careful integration, set the right rules, this is lovely. I mean, it really can help. And it's also very much needed, I think, to grow the supply that we're going to need in the future.
Yeah. Yeah, certainly. I mean, because what happened with EU ETS like 1.0 was they got burned by the CDM credits, right? Like, what was I would love to hear your opinion on that kind of historical situation, and kind of I think that's one of the reasons why they're very hesitant as to allow them back into the system because of what happened in the past.
Yeah.
Maybe like.
I mean, if you my take on this historically,
you break it down to the audience.
I mean, my take, and then I think Rene, I'm also interested to hear your take, to be quite honest. But my take is this: like, they try to do it. Obviously, policy has a lot of different roles to play. It's not only climate. There's a development angle. There's a global community, right? So I think it made sense to do it. Was the CDM the right thing for the purely looking at the climate impact? Maybe not, right? I think lots of shortfalls. Lots of stuff learned. I think the market as it exists today, and that's my takeaway always, exists because the CDM didn't work, right? So it's almost like private sector players started to almost think about what else can we do? Is there additional certification? Do you want to do different things? So I think it's been burned. And I think that's the key risk about integration. And you mentioned the central trading platform in Vietnam. And I think there's other countries, I think discussions are also going on in Kenya, for example, on having a state-owned central trading platform. I'm personally a bit hesitant to make it too centralized and too policy-driven, because I think so far we haven't seen policymakers being quick to react or set market standards that evolve quickly enough to really maintain good quality in the long term. And I think that's exactly what happened with the CDM. I think a lot of projects had a lot of impact, but as we evolved, as we were better at measuring carbon, as we were better off understanding what the actual impact is, well, some aspects I think we learned they didn't really work that well, or they didn't do what they were supposed to do in the beginning, right? So I think if we look at those integration cases, I think it's smart to think about, what role can the market play? Can we stay flexible? Is there a more decentral approach? Do we use also the market to help almost like find quality and pricing, right? And don't centralize everything, or again, come up with a global UN-backed standard that will be so high level, and it is by the nature of, I think, international policy work that is never going to be ultra detailed, to then, start repeating that same mistake. So I think that's really where we need to see a difference in the policy implementations now. I personally haven't seen it, so also interested to hear. But Rene, what's your take? I mean, you've been almost around probably in the market when a lot of this came to that.
That's a recurring theme I'm into. I don't know. Yeah, it's a long story, but yeah, look, the market whims have changed. I don't want to kind of litigate the already, like you said, you laid it out really well, right? But like CDM had its flaws. The Paris Agreement is designed to kind of alleviate those flaws. Now there's a cost to exporting these units from a national, like a host country's balance sheet. That's why we've got this whole issue around corresponding adjustments and the avoidance of double counting and this kind of more sophisticated accounting framework. It's still operationally very, very difficult and tedious, and we're seeing that with the kind of rate limiting step of issuing letters of authorization. But yeah, look, coming to the EU ETS, obviously that's well been documented, right? Like there was CRs were eligible, then they were not, and then we see the action in terms of price just traded. We see then the price action in terms of allowances, and that's run. And then there was over allocation, and then there was mechanisms to alleviate that. And it's a constant evolution. Right? It's never static. It's like a machine. You've got to continuously tweak it. And I think that's just the way it is. I think you look at the actual emission reductions of having a carbon price, and they actually lead to decarbonization in the industry, and it's a very effective tool. I think that now those systems that are emerging, we see it in China, and we're seeing it now in Vietnam, and we see it at the plethora of different systems. And we had Stefano De Clara last week from ICAP, who do a great job in documenting all those different systems. I think we're seeing an evolution of those systems where they used to be allowance-based purely after ETS kind of made this the process, to now including these hybrid systems. And it allows for fungibility, it allows for markets to really price this externality effectively, and it allows for all sorts of trading to emerge, it allows for job creation, it allows for finance to go where it can deliver the biggest outcome for the lowest possible price. And it's just, it's solid. So it's going to be different. Every country's going to have their own flavor. It's going to look different, and it's going to be really interesting. The cool thing is that this market is not stopping despite all the negative press in the kind of the regular media. Like, I cannot keep up with the number of stories that occur on Carbon Pulse and Quantum Commodity Intelligence. It is fascinating to see things happening and in real time, which is kind of the impetus for this show, right? We wanted to have global experts provide their views on this very not static, very dynamic and interesting market. And you have, so many different markets. Just look at the quantum, news stories, and it's very diverse. It talks about, tenders. You got, risk maps at Red Plus for Vera. You got all these acquisitions that are happening. It's just fascinating. It's really great. Sorry if I waffled on, if I didn't answer your question, but market's interesting. Eddie, you want to bring it back on?
No, 100%. And I think we can kind of take this next segment, into two different ways. There are some points that I didn't get to from the World Bank report that I did want to ask about, and we did discuss institutional finance. Well, there was this one fact that I found interesting. Like, it says that the pool of unretired credits from independent crediting mechanisms increased to almost 1 billion tons. And most of these unretired credits are relatively old, issued before 2022, and are from mostly forestry and land use or renewable energy projects. And, there's this...
Are these issued or verified? Because there's a latent supply of Red Plus credits under VM007 that haven't yet been issued as well.
These are issued credits. Like, this is the supply, surplus, right? And they're basically creating this narrative that, like, prices overall have continued to sell off, like have continued to come down, besides these few specific project areas, like we mentioned. There are some great graphics that I would love to show. Maybe Olaf can put them in. Yeah, I'll bring them up right now, actually. But
for folks listening on Spotify, this will be really fascinating.
That's great.
Like
multimedia, fellas.
Yeah, it's all in video now. Yeah.
Yeah, exactly.
What?
It's all in video. You can also upload video podcasts on Spotify now. So maybe that's a
we
start doing that. Okay, good.
We do. Okay, for folks that listen whilst on the treadmill, they'll have a good giggle. So Eddie, what are we looking at here?
Yeah, so this figure here is it's carbon credit issuances and retirements from independent crediting mechanisms and the volume of unretired credits from 2021 to 2024. So, the red line is saying that cumulative unretired is up to almost, 1,987,000,000 tons. And it's coming from
how many registries?
Yeah, probably around 10. So ACR, R-Trees, Biocarbon, Circarbono, CAR, Climate Forward, Gold, Navivo, Vera, and all issuance and retirement data here refers to original issuances. Yeah, there are some really interesting. This is like one graphic on this that I thought,
And so you're showing the delta essentially between issuances and retirements on a yearly basis.
Yeah, and I think like this impacts. Where's the?
I don't know if that methodology is actually correct. because it's a compounding bit, right? So okay, yes, there's less retirements on an annualized basis.
It is a good one as well for like
some folks buy and hold these credits. Like, I think we need to dispel this notion that the only purpose of the carbon offset or the carbon credit is to be retired, right? Like, it's still a financial asset, and we saw that, right, with speculative sort of participation in the market in 22 and 21 in particular, right?
Yeah,
where people would buy and hold it, and there was multiple funds. Now, there's folks that are sitting on large chunks of supply, and sure, some of it has been devalued significantly because there's very little on the bid side, but it still costs money to get a project to the market. And this is what I was referencing earlier. There's a lot of projects that have been verified but not issued because the cost of issuing is basically a cash flow hit for that project developer. And then if there's no bid, like if there's no bid in the market, then they're not going to pay their 25 cents or whatever it is to issue those credits. If the market bid is at 30, 50 cents a dollar, whatever, it doesn't make sense because the cost of implementing that project is it's at least $3 on the nature-based side for nature-based avoidance credits on the REDD+, at least 3 to 5, right? And so basically, you're selling under market. Right?
I mean, yeah, but I do look at the data though a bit differently also. I mean, it's because I think it's a combination of two things, right? I think we have, and that's, as we said, it's an interesting market. There's a lot of stuff happening, but I think you have a relatively quick change of buyer preferences. And I think if you look at renewable energy, I think quite frankly, what we see is that often they're ruled out to start with. It's like a hard requirement to not invest in those because there's questions about the additionality, et cetera, et cetera. And that's a whole different debate how true that is or not, right? And we had the discussion around the avoided deforestation.
No, but those are distress. There's no interest right now in the market.
But I think this is what we're seeing here.
Yeah.
Exactly. But this is what we're seeing. And I think the other component to this is the nature of projects is that you set them up and they run for a long time and they keep somehow also issuing, right? Although you're right, there's, I think, a lot of supply that hasn't been issued effectively because it is quite expensive in some cases. But I think what we're seeing here is that we have this project running from the past that keep issuing basically, but they don't find buyers anymore. So I think there is definitely like a distressed component that we're starting to see, which I think makes it so hard. And we had the discussion around the long-term offtakes and the forward agreement. I think that's exactly what makes it so hard, right? If we look back, that's exactly where you don't want to be if you commit for like 3 to 5 to 10 years. And that's kind of probably where you really need to be ultra smart around like where you put your money.
And it's going to it's not just that, but you also have to be lucky that this doesn't happen to nature-based removals in 5 to 10 years
100%.
time, right?
100%.
And I hope it does, and I hope that the lessons have been learned in this drive or flight to higher integrity. But a lot of the REDD projects, they really were high integrity. It's just that now with this revisionist kind of history around baselines and et cetera, there's this now prevailing notion that every REDD project has been over-crediting. That's not the case. And we're stuck in this kind of valley of death with this new methodology VM48 going from 007. There isn't a clear pathway for a lot of projects to be kind of transitioned across. It's the project developer needs to do that, take that step, but the owners of those assets can't just apply a discount and convert it under the new methodology. Because if they could, I think that would be a really solid solution, right? To the market to say, okay, well, what is the discount factor? If I discount 20%, 30% of the volume to then get issued a new VCU under this new methodology, I can effectively now assuade these questions around over-crediting, and presumably there's a buyer that's now much more confident because there is still a very deep pool of supply there. But in the absence of that, there's really very little incentive for a project developer that already sold those tons to retrospectively want 100%. To try to transition them. So now it's a stranded asset. You bought it, you hold it. And so what happens? At some point in time, which I think is now, the market just delineates everything on the left side of that curve, we're not touching. Everything on the right side, we are. And all those project developers that are essentially now holding on to, like you said, a project that should be yielding supply, now have faced with a perverse incentive. Well, do we actually stop the project, cut it down, and now reforest it? Like, that's the perverse outcome that they're faced with. Or do we protect these natural biomes that provide such a really strong carbon sink, but really incredible biodiversity benefits to the planet? It's a crazy thing because of this puritanical view around over-crediting. It's not exactly 1 ton. It's like,
I mean, it is indeed, I think, crazy. And I think it often is also not necessarily super aligned with with the climate impact, to be quite honest. Like there's still a lot of value in like not destroying ecosystems before we start rebuilding them, right? So right now it's a better business case to literally use the forest land, like build whatever and plant whatever, instead of like protecting rainforests that we will never be able to rebuild, right? And that is a bit of a, I think, a problem in the market, but it also comes a bit from this dichotomy of removal versus avoidance, where I think many don't really look in all the details. But looking at that dichotomy, actually, I think we also see it in the prices. I think, for us, it's been, I think the prices that we've been observing across all projects that we work with and that are listed, we saw, I think in removal, like a 30 to 40% increase in prices over the past year, and that's a global average, mostly obviously like driven by the nature base, just for the largest volumes. And then avoidance has been going down, and that has been largely driven by renewable energy credits, right? Which are really like at all-time lows, because there is literally a sense of that's a stranded asset. We can't touch that. We won't buy that. And the other thing I think is like that comes on top is the older a vintage, the less likely it is for someone to buy it, right? So it's almost like as we keep amassing, if you have something from like 2015, it's almost impossible to get a deal. Although obviously like the credits might still not have been retired or might still be purchasable. No.
Yeah, definitely. But it's interesting because now, like one just reflection that I'll add, I completely agree with what you said, is now we're talking this financial language. We're looking at carbon as an asset class. We're seeing inefficiencies in kind of the policies, and we're seeing inefficiencies with regards to methodologies, et cetera. I think that there's this collective movement, and it's such a broad participation of different actors in this industry that are really bringing a level of sophistication and rigor and what willing this market to the future, right? It's so imperative, and we talked about it a couple of weeks ago, Eddie, around, we're not bending the curve in any material, meaningful way. And so all we're doing is by essentially deferring climate action, we're actually ensuring this, much greater than 2 degrees, most likely a 3-degree future. And so it just creates inevitability that we need to price carbon. We need to transition our economy towards a much more decarbonized state. And that means that the price of these assets will continue to appreciate over time. There may be deviating away from the fundamentals right now, but you want to be long carbon in the 2030s, 2040s. And I think that realization is, I think, well understood, and we're starting to see more and more participation. Corporates, I think, are the wrong proxy for it. I think we need to start seeing more of these investors enter this market, and I think we're seeing some early signs that is certainly the case, because corporates are ultimately the end of that road. We need the financing folks to step in, provide that financing, debt, equity, milestone, streaming, whatever it might be. Projects to start to implement, see greater efficiencies, greater output, greater strive towards up and to the right in terms of integrity. And even with all of that, and like you said, protecting native biomes as well as establishing and restoring ecosystems, we need to allocate a quotient of capital that's at least 2 orders, 3 orders of magnitude greater. And then the demand really then starts to materialize. And we see it through what we discussed with compliance systems and the like.
Exactly. And I fully agree. And I think just to second that, I think we see, again, I think all the right direction is being is already happening, right? Like we see, I think, sophistication on the MRV side, on the supply side. I think we also see sophistication on the buy side. And to your point, I do want to argue that I think it is important for buyers to also step up early, because I think otherwise it's going to be hard to, I think you also can't force the finance community to invest in a market that is completely abstract in what you can get for it, right? Like you need to have some pricing, you need to start building the book, you need to start building the history to make sure that works. And I think the process that we're going through now and have been probably going through, I think for the last 4 or 5 years, I think it is probably painful, like in many ways, but I think it's also necessary, because the outcome seems to be that we are actually getting better at understanding what quality is. It gets more stable. And I think that's also what we need, right? We need to make sure that what we're investing in is the right thing. And I think sometimes that gets a bit forgotten. And I think in the overall conversation, there's probably a limit of how much we can invest in carbon removal globally as humanity, right? Like there's going to be resource decisions to be made, and there's going to be a lot of mitigation financing needed. So we need to make sure this also runs efficiently, right? We need to make sure there's the most efficient way to get there. And I think as long as we're on the path to finding this, the carbon markets can be an incredible tool. And I think we see that happening already now.
Yeah. I think that's really well said, guys. I think that's like perfect transition or kind of closing out to this episode, like the way that you both articulated that with those key takeaways. It was kind of like a call to action, right? So, again, I would like to thank Magnus for joining us today. Really appreciate your time and insights, and Rene as well. Always the weekly bestie. Always nice to have you alongside. And
Thanks for having me.
Thanks for tuning in to This Week in Carbon.
Thank you.
And be sure to follow the show and share it with someone interested in the carbon markets. And catch you next week. Until then, keep learning, keep moving the needle, and that's a wrap.